Good morning, everyone. Can you all hear me? I think we're going to get started now. For those of you who don't know me, my name's Brandy Scales. I'm a senior manager in our HRS practice here in Toronto. And joining us in the audience today, we have our national practice leader just making his way to the back there, Dave Peters, as well as our GTA practice leader up front here, Michael Colvin. And on behalf of Dave and Mike and all of us at PwC, we'd like to thank all of you for taking the time to be with us here this morning. We appreciate how difficult it is for you to block 2 hours of time to share this morning with us, and we do keep that in mind when we select the topics and speakers to bring to you through this venue. This morning our speaker is Justin Addison-Smith. Justin is a senior manager in our UK tax practice. He joined PwC back in 1998 and since then has helped many multinational organizations with their global mobility framework as well as navigating the UK very complicated tax compliance scene. So I have the great pleasure of working with Justin on a mutual client. And one of the key attributes that I've come to appreciate about Justin over the years is his ability to make the complicated simple. And I am promising that he will do that for you here today as he takes us through some of the most significant UK tax legislative changes that we've seen in the last few decades, from the statutory residency test to foreign short-term business travelers and how we report for them in the UK now. These changes most certainly are going to impact how we do business in the UK. So with that, Justin.
Okay, good morning everyone. As Brandy said, there's a lot of changes in the UK at the moment. So hence the title of my presentation, The Perfect Storm, relates more to the weather in the UK rather than the changes. But I thought it was a good title. There are a lot of changes in the UK at the moment, and that's why we've come together today. So if I go over what I'm going to talk about today, I'll talk about what we had prior to what's happened in the UK around the changes. Then I'm going to go through some of the changes that have happened. As Brandy mentioned, we've had changes to how we treat people in the UK from a residency perspective. That's the statutory residence test, which is now law in the UK. Prior to that, we didn't have any law around residency in the UK. It was more guidance and practice. We're then going to talk around real-time information, and that is the changes that have happened to payroll in the UK domestically, but it also has an impact on the expat angle as well. And then around all of that is how you govern around expats and the payroll. Tax risk assurance, it's much wider than that, but this is from the expat angle and how we handle that. So, what we have here is a pictorial of the perfect storm. So, as we said, in the UK we have how you are handled from a residency perspective, and that dictates how you're handled from a payroll perspective and how we tax people in the UK. And then around all of that we have the governance. Some of these changes are quite large around the expat world, and it really has an impact, especially at the governance piece, because if you get any of these things wrong, real-time information, or get somebody's residency wrong around SRT, as we call it, statutory residence test, you can be in some quite heavy penalties for yourself as the employer, but also the employee. So, we'll talk about first the statutory residence test. I'm going to try and keep this high level because this is quite complex. We have about 80 pages of legislation on this, and we've had 40 hours of training in the UK to try and get us up to speed. We're still trying to learn it now. It's in place from 6th of April. We're still applying it to our clients, new people coming to the UK, leaving the UK. Everybody's different. Everybody has different circumstances, and how you apply that test is different for everybody. And trying to, having been a seasoned professional in the UK around this, trying to go from one set of rules you've done for so many years to these new tests is a bit of a challenge as well. Hence why we've had so much training. But first of all, let's talk around what we have in the UK and a bit of an overview of the UK tax system, just so you're slightly up to speed. I'll try and not make this too technical. We have capital gains tax, which is preferential for people in the UK. There's lower tax on capital gains in the UK. I won't go too much into that. We then have income taxes, and they That's what we're primarily talking around today. It's obviously tax on employment income we're going to cover. Our rates in the UK are 20%, 40% and 45%. The 45% tax rate kicks in at £150,000. And we also have personal allowances in the UK. There has been some changes around how people are entitled to personal allowances. It's currently around about £9,500 now in the UK. Previously, nearly everybody could get a personal allowance in the UK, Commonwealth citizens, whether they were resident or not, EU people, resident people. It was pretty easy to get one. But with these changes that have now come into place, the personal allowances can actually drop away quite quickly, depending on earnings, your resident status and things like that. And that can be a bit of a shock for some individuals when they're working in the UK, because they may have had that allowance given to them through the payroll. They then file their tax returns, and due to a filing status, it gets taken away, and they have a tax charge on their personal allowances, which we're seeing quite a lot of, and can be a bit of a pain for certain expats, because they think they've had all the withholding at source, and in actual fact, they've got a tax charge. We then have inheritance tax. That can in fact impact some of the inbounds to the UK, but only when they've been in the UK for 17 years, and they start having to pay inheritance tax on their worldwide inheritance tax when they're estates. Value-added tax, VAT, sales tax, 20% in the UK, which is quite high. I can't remember what it is in Canada. What is it here? Sales.
It varies,
Yeah.
but in around 13%.
Okay, all right. Which is always a shock for me when I come to Canada, because you look at something in a shop and you think that's the price you're going to pay at the till. In actual fact, they add on the tax on top. Whereas in the UK, it's slightly different, where it's all in the price. We then have corporate tax. There is some work being done to reduce our corporate tax rate in the UK to make it more beneficial to people to come to the UK. We are seeing in the UK at the moment more companies move hubs and businesses into Switzerland, where there's actually quite a preferential tax rate. So we're doing a lot of work around moving staff from the UK to Switzerland. Except now Switzerland's saying they've run out of places for people to live and school places and things like that for the family. So it's becoming a bit more difficult to go to Switzerland. Another one, a big topic, is Social Security. I'm not going to cover that today. I could probably do another day session on Social Security. It is a very complex area, particularly in Europe. We had a 2-day training for the staff last week, and we had an hour session on Social Security. And we're meant to be experts in Social Security, but the session for an hour just blew our minds, because it's really quite complicated, especially in Europe. Between Canada and the UK, it's a little bit easier. You just get certificates of coverage, and it's fairly straightforward. But Europe's difficult, in case anybody here looks after people that are moving around Europe. So the key taxes, obviously I'm focusing on income tax today. UK tax year, you may be aware, our tax year is not a 31 December year end, it's the 5th of April, which is obviously quite logical. I'm not going to go into the rhymes and reasons as to why. It's something to do with the Gregorian calendar or something like that. There's many stories as to why it is, but it is that. It is difficult when you're trying to do people's tax affairs and trying to marry up foreign tax credits and things like that, trying to marry that up. Cash flow disadvantages for filings as well. It's an odd tax year. I can't see it ever changing, and I think we're the only ones left in the world with a 5th of April year end. Ireland used to have one, but they went to a normal calendar year end. Not everybody, self-assessment, not everybody in the UK has to file a tax return. I don't file a tax return, everything's withheld at source, and a lot of people are like that. There's only certain categories of people that actually need to file, typically expats, because they've got extra things they need to put on tax returns that haven't ordinarily been taxed at source. Individuals that earn over certain levels of income, and people that have income that isn't taxed at source, such as rental income. So not everybody needs to do it, and we're moving more and more away from actual people having to do tax returns. So these changes with our real-time information actually are lending themselves to less people having to do actual tax returns, because RTI is meant to probably allow people to have everything put through payroll and withheld at source, so that nobody should need to do a tax return anymore. But we'll see how that pans out. And then lastly, filing deadlines in the UK. As our tax year ends on the 5th of April, we then give everybody until the end of January to file their tax return. They can do a paper one by the end of October, and it's actually electronic filing by the end of January. And they have to pay their tax by then. There's no extensions in the UK. And we don't do joint filing, it's all individual filing. So, I'm going to start walking around now. So, residence does impact how people are taxed in the UK. Because of the statutory residence test, we've now got people that are resident or non-resident, and that's the same for a lot of countries. You may be aware that in the UK we had a funny status called resident but not ordinarily resident, which was difficult to explain to expats when they came to the UK, because it's sort of a temporary resident status. That's gone away now, but the reliefs that were attached to that particular status are still in play, and I'll come on to that later. As it says here, it does impact the reliefs you can take, but primarily residence dictates one particular relief around when you're working outside of the UK. But let's talk around what we had prior to 6th of April, and then we'll carry on with what happens after 6th of April and why the changes have happened. So prior to 6th of April, we had guidance, publications. There was no law around how we determine somebody's residence in the UK. There was case law, court cases, where people had literally interpreted the guidance to the letter, which was never the intention of the revenue. So this case has come to court, and people debated what came out. And there's several cases that dictate how we handle people. The one that's the key one is the case of Mr. Gaines Cooper, whether you've heard of that, and he was an individual that basically tried to stay within the limits, and the limits in the UK at the time where you tried to keep your days below 90 in the UK on average, such that you didn't trigger residency. He did that, but he also had his family in the UK, and he kept visiting his sick son and this, that and the other. He actually lost that case, which dictated the changes to what we have today, to the statutory residence test around the quality of life that people have in the UK. He basically lived in the UK but happened to try and keep his ties in the Cayman Islands where there's no tax. Unfortunately, that didn't go well for him, and he's had to pay many millions of pounds to the UK Exchequer. But the important piece there is that the revenue said that the guidance that he took literally actually didn't apply in his case. So we're now to a place where all revenue guidance seems to be irrelevant. So we then moved into what was called another booklet the revenue wrote around residency as a result of that case, which was quite a thick book. It went into a lot of detail. It was heavily caveated and contradicted itself in places. So for a couple of years, we had this book that really didn't help us with how you treat people's residency. So then as of 6th of April, we moved into the statutory residence test, which helps us to determine people's residency. I wouldn't say easily, because it's not that straightforward. It's quite complicated in some places. There's still some things that we still look at in the UK when we're looking at people's residency. Whether people are working full-time abroad is still an important point when they leave the UK. Day counting is still important, but we look at the quality of the days and how many. People's facts and circumstances are clearly important. And the intention-based piece, prior to 6th of April, a lot of people, you had to look at whether how long they intended to be in the UK when they came to the UK, which then dictated the reliefs you could take. So you may be aware of the 3-year rule. If you were coming to the UK, you tried to keep people less than 3 years to allow them one certain tax relief around working outside of the UK. There's also the 2-year rule. When people come to the UK for less than 2 years, there's another tax relief available. There is still some intention based around the 2-year rule, but the 3-year rule's gone away now. So if you want to send people to the UK for a longer term and aren't necessarily worried about giving them certain reliefs, then the intention is sort of gone away a little bit. Right, so let's talk about what the test is. There's 3 parts to the test. One is looking at whether you are automatically non-resident, which is the automatic overseas test. And there's parts of that, and I'll come on to that. If you fail that test, is the first test. If you fail that test, you fall into whether you're automatically UK resident, which is the automatic UK test. If you don't pass either test, and I'll show them when we go through them, then we have to look at what sort of ties you have to the UK around family and accommodation and the work that you have in the UK. And then that should help dictate whether you are resident or not in the UK. I'll ask if there's any questions so far, otherwise I'll just keep going. If anyone has any questions, then just raise your hand and we'll answer them. Right, we'll look at outbounds first. So this is looking at the automatic non-residence test. So individuals that are leaving the UK, let's say, and coming to work in Canada. 3 key issues that come out of the automatic non-residence test. One is you need to prove that you're working full-time abroad. Now, when you're looking at whether somebody's working full-time abroad, we actually have 3 parts to that. One is, are you working more than 35 hours a week on average overseas? Now, everyone might think, yeah, everybody works a 35-hour week, unless you're, one, a part-time worker, or secondly, somebody that actually just does core hours, 9 to 5, actually may not meet that test because there's a pretty complicated calculation in the legislation you have to go through, looking at the types of days, days off, sick days, this, that and the other, to work out whether somebody's done a 35-hour week on average. If they're doing their core hours, a pure 35-hour week, they may not actually hit that and could actually not break residency of the UK. You know, people that do hit it are the ones that are working 50, 60 hours a week, so they're generally okay, as most expats do, obviously. Another point is, during that time outside of the UK, you shouldn't have any significant breaks of more than 31 days. So if you've got one of your expats that decides, I'm going to work full-time abroad, and then has a long period of leave in the middle, sick leave, decides to take a month off, etc., that could impact upon whether they are a non-resident still under this test. And then day spent. This is the one where I have a lot of conversations with people. Brandy and I had one just the other day around the amount of time an individual can spend back in the UK to ensure that they are automatically non-resident of the UK. And the days are, you shouldn't spend more than 30 work days in the UK in the tax year, or more than 90 days of presence in the UK. And a day for residency is where you are at midnight. And that wouldn't matter if you came to the UK at 10 p.m. and you stayed over. That day would be a day. And the way you count the work day is where you are for working 3 hours. If you work 3 hours in the UK, that is a work day in the UK. Now, people coming from Canada back to the UK, I'd imagine they would work for 3 hours before going back again. But where we have an issue is typically people that are in Europe and coming into the UK, doing a meeting and then going home. People think, oh, I've only got an hour's meeting in the UK, so it's not a day. But in actual fact, it's for the point of departure from your mode of transport to the point of getting back on that mode of transport that counts. And the slight thing is on the basis that travel's been reimbursed by your employer as well. So if you came on the Eurostar from France and then got on the rickety old tube to the meeting, did your meeting for an hour and then got back on the tube, had to delay and everything, and then got on the Eurostar again, you would likely have hit 3 hours, and that would be a day for residency. The 30 counts towards the 90 as well. It's not 120. Yeah. So these things, we just need to keep an eye on them. If you exceed any of these things or don't meet any of them, it's not the end of the world. You could still be a non-resident, but you'd fall into whether you look at the next test, the automatic residence test, and then you look at the significant ties test. Generally, you're down to the significant ties, but I'll come on to that. So, as I said, when you're sending people out of the UK, employers need to be wary of it could actually be more difficult for individuals to break residence of the UK. Maybe your intent that they will, but they may not actually, because of their time spent back, because they may have family back in the UK visiting. They may still have work to do. They may still be managing teams back in the UK. You've got to just keep an eye on there's more information needed about what your employee's doing rather than just sending them off into the Canada. Which then comes into, and I will touch it later with the RTI stuff, is that if somebody doesn't break residence of the UK, then you could potentially still have payroll obligations in the UK, and you could have double withholding both in Canada and in the UK. To make sure that you're compliant from an employer's perspective. And then it's keeping a good track of days. Employees and employers need to track the days that they are back in the UK to ensure that they're not contravening any of those tests for the automatic test. Where we have difficulty here is when we're doing tax returns, people haven't kept this data, and the tax returns will ask for, are you working full-time abroad? Did you do more than 35 hours? The non-residence pages of our tax returns do go into a lot of detail now and ask all of these questions to make sure that people have not become residents again. And because it's all computerised and there's e-filing, it goes straight into the system and will kick out an automatic audit if you contravene any of the levels. Now, when you send people outside of the UK, depending on how you're doing it, whether you're sending them as expats and equalising back to the UK, or whether you're sending them as a local, there's certain things you need to be wary of. If you're keeping them on UK payroll, and that may be because of Social Security, they may be under a certificate of coverage and keeping them within UK Social Security, you'd generally be still having to run a payroll, a shadow payroll, but you'd need to run what's called a no tax code to make sure you're not actually paying over any taxes because there's no tax due as a non-resident. I'll come on to it a little bit later, but if somebody does remain resident, then that no tax code is not relevant. You'll be running it against their residency status, and then you can find yourself with penalties and interest for getting your payroll wrong for running an incorrect tax code. You need to keep an eye of whether people are returning for family or work, so it's just keeping a better track of people returning back to the UK and keeping the track of those days. So the key thing here for people is the day thing. Whenever I meet expats that are leaving the UK to go abroad, so to Canada, the key thing I tell them is track your days and where you are. That's the key thing. Okay. Are we good? Okay. Another 3 hours of this. Is that okay? Right. Inbounds. So that is, we've just done outbounds. That's people leaving the UK. Because I'm in Canada, I'm sort of getting myself confused. We're going people from Canada to the UK now. The statutory residence tests, I'm not sure if it's been designed as so, but it does make it hard for people to break residency. So when people are coming into the UK, they can quickly become resident quite quickly. The main test is, when we're looking at this, is are they in the UK for more than 183 days? That's a typically standard test for most countries, 183 days in the tax year. If you hit that, then you're resident. If you don't hit that test, then we go down to whether or not you have a home in the UK. And we look at where you have an only home. And where this becomes a bit of a problem is around individuals that, I take the example of management trainees. You may be sending people around the world for 3-month stints here and there, just to give them an experience of working in different countries and different cultures. They may be, a graduate that's just left university, maybe living with their parents. You send them out to the UK. You put them in a rented apartment. That, in actual fact, could be their only home. If you meet that condition, you could actually become a resident, even though you're in the UK for a short period, 3 months. And then you look at whether or not you can use a treaty to tie them back to the country they came from. But if the treaty conditions are you need to have a family back home, or a permanent home in your home country, or things like that, you may actually not have treaty protection and could actually find yourself a resident of the UK. So then you've got to start payrolling these individuals that haven't got homes elsewhere. We haven't seen a lot of that yet, but I can see it coming, particularly with the sort of, I think one of my clients called it backpackers. If you have a home in both places, and you can, in both, then you have to just look at whether or not somebody's working full-time in the UK as well. Again, similar test, big old calculation, looking at whether they're doing the 35 hours a week on average. UK, we work 100 hours a week, everybody. So, it's fine. So as I said, the home point, the revenue still haven't, when I say revenue, it's the HMRC, Home Majesty's Revenue Custom. The revenue still haven't given us very much clarity around what constitutes a home. There is guidance, but it's still uncertain. So when we're meeting individuals, talking around whether they have a home or not, there's limits around the amount of days you can spend in that home, whether it actually therefore constitutes a home, the availability of it, For some people, they may be living with their grandmother in a little shoebox room. That could be a home for them. There's all sorts of different varieties of ways that people live. And the revenue haven't knuckled down all of the areas around that. So looking at the home is one of the areas that we have to be careful of. Hello.
Do you have any much activity around virtual and remote work arrangements?
Yeah. The UK is very much on physical presence. Yeah. So if you're sat at home virtually but doing your work in Canada, you're actually still working in the UK. Similarly, if you're sat in Canada doing your work for the UK and you're not physically here, then these wouldn't count as work days. So it's physical presence.
Good question. You keep talking about the 35-hour work week. Most folks are salaried, and your normal work hours may be 9 to 5. How do you deal with the fact that they may not be working 9 to 5? So how do you deal with that? No one's clocking in and clocking out.
Yeah, that's a good question. The UK is self-assessment, so you self-assess yourself, to whether or not you're resident or not. So it's almost like an honesty thing, really. You then send your tax return in and you could get an inquiry, and the revenue could come out and say, right, you need to prove to us that you've worked a 35-hour week. So it comes back to the tracking of your days. It's around tracking the hours you worked almost. Now, if you know that your typical day is 9 till 6, you take an hour for lunch, you can pretty much work out what you're doing. How you'd prove that, it'll come back to looking at your emails. You could do a timesheet, PwC do timesheets. It is difficult to do for people that aren't on timesheet or able to track it, but I think as long as you can prove that, and the revenue is sort of fair. We haven't seen inquiries on this yet because this is quite brand new as well. It will come back to just trying to prove it as best as you can, So yeah.
Could you define it in an employment contract? So when you set up what the terms and conditions of employment are?
Yeah, I mean.
Say, such and such a day work week.
Yeah,
Standard hours.
yeah. In typical assignment letters, we do see your typical working hours will be this and this, and an hour. That's what you typically see in an assignment letter or the employment contract. So you could hang your hat off of that. I mean, that's about the best you can do, So, and in the UK, we have this EU working time regulation. Whenever anybody signs up to a contract, you waive your rights to it, and that means you can work more than 48 hours a week. So there's things like that as well. So it's a difficult one. We haven't seen it tested yet. The calculation we have to go through looks at, you remove holidays and sick days and other days if you're part-time working to work out whether or not somebody's done a 35-hour week. I did an example of it, and it's quite, you can hit it quite easily, the 35 hours, only when, and what the word of caution is, if it's somebody doing a pure 9 to 5 with their hour for lunch, they would have to work every 240 days, basically. You have to be careful of other days outside of that. Okay, I think I've done everything on here. Yeah. Short-term home tests, short-term assignees I spoke about, and then people that come into the UK could be based here and could have a European role, for instance, and they'll be taking the tax relief on having those days overseas, and I'll come on to how that works in a bit. But because of those overseas work days, they may actually find they haven't done 183 days in the UK if they've got significant travel, and they could find that they're actually not becoming a resident of the UK because of the amount of travel they have. So it's just one to bear in mind. If you've got somebody who's working a lot, it's not a fait accompli that they're a resident of the UK when they come and work here. They could be doing a lot of travel, and coming back home to Canada, it's just something to bear in mind. Again, it comes back to tracking. I'm going to gloss over the first point because it's not quite right, but what that probably should say is detached duty relief. One of the key reliefs in the UK that we plan around is a relief called detached duty, which hopefully some of you have heard of. So people coming into the UK, they need to be coming for a temporary purpose and to a temporary workplace. And the way you do that is you either keep them on their home employment contract, or have some sort of organic link back into the Canadian employer. A good test of that is, are they still in Social Security in Canada, which is a good test to see if they're still got an organic link back to the Canadian employer. And you're sending them to the UK for up to 2 years or 24 months. That allows individuals, therefore, to not pay any tax on any employer-provided accommodation, so rent, provision of a house, gas, electric, and things like that. That wouldn't be a taxable benefit upon them. It'd be a reportable benefit, but one we wouldn't tax through their tax return. You can also take relief for the travel expenses between the home and the office, so getting on the old tube would be a tax deductible. If the individual was paying their own taxes, and we do see some people on what we call modified host arrangements, where they are still employed by their home employer, but they're actually paying their own taxes in the UK as an expat on a temporary basis as well, then again they can take that tax relief for themselves and see a tax rebate through their tax returns, because they're taking a deduction for their rental expenses and the housing. It's quite a nice relief that we still have. Again, I want to stress that the assignments need to be structured for up to 2 years. Longer than that, relief goes away from day one. And at the point that you decide to extend somebody's secondment beyond that 2-year point, it stops at the point of the extension. So if you're at the 20-month point, it stops at that point.
What's the audit like? How much are the audit?
They're getting better at auditing that claim. What we've found in the past is that employers have self-assessed their employees to tax duty relief and then haven't reported the benefits that they're getting. So then it doesn't go on a tax return. So then no audit comes as a result, because the revenue don't see this claim, an expense going in and a claim being made. So under all these changes with RTI and things, employers now need to make sure they're reporting everything. So we're going to start seeing more inquiries, because you're going to see the expenses going in on the reporting and claims being made. And these are quite hefty claims. But when we do see a lot of audit around tax duty. And what comes out is the revenue will ask for, right, we need to see the home employment contract, the assignment letter showing 2 years, that this is a temporary workplace, that there's been no extension to that secondment whilst they've been in the UK. If you're depending on how far you're taking this relief up to, they ask for the copy of rental contracts to make sure it's not pushing anyone beyond the 2-year point as well. Because if you sign up, year plus a year could take you beyond 2 years. That one's an easy one to generally argue. And also they want to see, given the amount that you're claiming, is that what you're actually spending? Because really it's only a claim for the individual. It's not a claim for the individual plus their family, because you're only in a temporary workplace. I have had pushback from the revenue on senior executives, because they bring their families to the UK and then they go and live outside of London in these 5-bedroom houses and make claims for these, maybe 60% of the cost. So then we go through a comparison of that house out in the suburbs versus a 2 or 1 bedroom flat in the centre of London to say, well, it's just about the same cost, so let us have the relief. That's the sort of thing you have to go through. I did have one individual who was an expat in the UK, and he started seeing his secretary, and then they were both claiming to tax duty relief on the same property. That was a fun. And she was also paying him a rent as well, which was also great. So you have to be a bit careful about how much you claim. There can be some big numbers, as you can appreciate. There used to be better planning around accommodation in the UK, but the revenue have taken that all away now. So the only relief we really have is the tax duty relief. Second one is overseas workday relief. Now, overseas workday relief, you used to have to, when you came to the UK, you used to have an intention to be here for less than 3 years, and the paperwork generally had to support that, or your intent had to support that. So if you were here after the 3rd anniversary of your arrival and you had made these claims in the past, the revenue would want to know, well, why are you still here? What is this claim? Was it always intended to be here for longer than 3 years? particularly the ones that are on local terms in the UK, if they've come here on local terms. That's an open-ended contract, there's no length of time on it. Revenue liked having a go about that one, and often won, sometimes didn't. But this relief allows you to just to take it to you take the salary, you work out how many days they spent working overseas out of their total work days, work out a number, and provided they have kept that amount offshore in an offshore bank account, and there's bank account structure you have to take into account, then they don't pay any tax on it. If they're a non-resident of Canada, for instance, as well, then they could pay no tax on that amount of money at all. So it's quite a nice one to have. But what's changed with this one is, rather than having the intent to be in the UK for up to 3 years, it now just applies, regardless of intent, from the tax year of arrival and then the following 2 tax years. And that's it. There's no argument about that. There's no need to worry about intent anymore. But it only now applies to those that are non-UK nationals, basically, i.e. the non-DOMs. And I'll come on to domicile in a bit, but the non-DOMs. So if you have an expat that's left the UK and come back to the UK who's a UK national, they can't take that relief because it's no longer applicable to non-UK nationals. Sorry, UK nationals. So then it comes into, when you're looking at sending people to the UK, making sure you're taking the best of those tax reliefs. So is it appropriate to use 2-year assignments? Is it appropriate to give people tax duty relief? Is it right to give people overseas workday relief? It's just making sure that you're making the best of the tax claims that you have. The last one here, which I haven't touched in the earlier slides, is around moving expenses. When you move people to the UK, you can have, or when you move anybody, even people in the UK, you get up to £8,000 of relocation tax-free. That has not moved in all the years I've done expat tax, so it's slowly getting a pointless benefit. But there's things you can do around moving expenses. It's that typically when you move someone, you pay for flights, you'll pay for storage, you'll pay for temporary accommodation initially, a month, 8 weeks, and then the movement of goods, typically. The 8,000 we can use, if you've got somebody who's under tax duty, for instance, the housing, the temporary housing you can put under the tax duty, so that saves more of the 8,000 for the movement of goods and the storage. And the flights we can do under separate legislation as well. So we can try and, we do our best to use as much of the 8,000 against actual relo as we can. But some employers do get that slightly wrong and put everything to do with the relo under the 8,000. Obviously it exceeds 8,000, they pay tax unnecessarily on that expense. It's not required. You can plan around it a little bit. Except where one of my expats decided to come over on the QE2 from New York because the dog wouldn't fly in an aeroplane. That was an expensive relo, especially when they were buying Ray-Bans in the shop and going to the casino. Right, so that's the easy bit. We're now on to the complex stuff. Now, this is if you fail the automatic non-residence test or the automatic residence test, then you get into whether you have any significant ties in the UK. And depending on how many of these you have, it dictates how many days you can spend in the UK for residency. And the day for this purpose is where you are at midnight. So let's say we've had an individual, he's come to Canada, but he still has his family in the UK, and I'm thinking of one example at the moment from the other day. His family's still in the UK, hence he'll still have available accommodation to him unless he's not in the best books, but probably will have accommodation as well. And potentially could be working more than 30 work days as well, because he's coming back to see his family. He may actually just go and sit in the UK office and do some work, or sit at home and do some calls or whatever. These are work days. If somebody has those 3, for instance, and they had been a resident of the UK quite recently, last 3 years, then they can only actually spend 45 days in the UK. There's a table, I'm not going to show you the table, there's a table you go through. And if they exceed the 45, then they're a resident of the UK. Okay, fine. We then look to the double tax treaties and we try and get them out of tax in the UK to try and keep them a resident of Canada in this particular case, so that you're not contravening, but there could still be a tax implication and a payroll implication because of the fact, if they had the 40 work days, you'd have to tax the work days even as a non-resident. So you've always got to keep in the back of your mind, people that are coming back to the UK and maybe non-resident may still have an obligation from a payroll perspective, and we should be payrolling them. Yeah. So this is where it gets more, this is more the difficult end of things, and you really got to get into people's personal circumstances, and that's what I do as a professional, but some employers need to do that to make sure that their payroll's right, particularly around the workday piece. Okay, this is getting even more complicated now. So I've talked around what you do in a full year for people when you're non-resident or resident, that's a full year. But then you've also got the years of arrival and departure, and we call those split years. This one is for people that are leaving the UK to go and work overseas. We have three tests you apply to see at what point in the tax year do they become a non-resident. And this is important because typically you send somebody out to the UK, you'll turn off the payroll at that point. But should you have done, depending upon which of these ones that individual will hit. The second one is around the accompanying partner, so we won't worry about that one. But the 1 and 3 are important. And it used to, when we were consulting on these tests, the revenue was saying, whichever gives the worst case is the one you go with on the date, which is ridiculous, frankly. But they've changed that now. But if you, for instance, had somebody who was going to work in Canada full-time, they leave, but they still have left their family behind to finish the school year, per se, the revenue would have said, actually, you become a non-resident from the point your family move, which is 3, ceasing to have a home in the UK. Revenue have calmed down on that now, so it goes back to 1. When somebody starts working full-time overseas, then you're a non-resident from that point, and the family can follow after that, so that's fine. With split years, though, the days back in the UK are prorated. So if somebody left in October, you could only have 15 work days back in the UK, because that's 6 months into our tax year, or 45 residence days in that year. And again, there's another table, which is horrific, but I'm not going to show you it. So that's the split years for people leaving the UK. Right, inbounds. I put some little writing down the bottom here because it's if you read it, it's idiotic, because it's all mixed up. The revenue originally wrote these cases just in an order, but they now have a priority order. So previously it was the worst case, the revenue said. So whichever happens first, when you're coming, inbound to the UK, whichever happened first was when you were resident from. Now this caused a problem, particularly with 6. If somebody was working in Canada and stopped working full time and said, right, I'm going to go and do a bit of travel for a month before I start working in the UK, in actual fact, you become a resident from the point you stopped work in Canada and was having a jolly in Las Vegas. And that's a problem, a bit, because you probably weren't earning anything, but it's just a point to raise. But the revenue have now calmed down again on that, and we've gone with this. I won't read it out, I'm still trying to get used to it. But whichever gives you a better case, and the one we're mostly concerned with is starting full-time work in the UK, that's when we'd start taxing somebody from. That's the most logical answer. But this can bring some funny answers when we're looking at people with certain circumstances. Families may have stayed back, family may have come ahead, the home may have started before they start working full-time in the UK. There's all these funny little nuances that come as a result of it that could mean that somebody's resident earlier, which means you may have a payroll obligation earlier, because it could drag in income that they were maybe earning in Canada, which may be taxable in the UK under payroll, and the payroll obligations with it that come. Kim, you were waving your hand.
Just thinking, can a couple or a family, partners, have 2 different departing dates or 2 different entry dates?
So for let's say the expat, he has 1 date, and I've gone with he, it could be a she.
Thank you.
Yeah. The person could be, because it's individual taxation. The family coming at a later date could have the later date, accompanying partner, no, owning home, or starting to have a home, 8 could apply for the family. And if it's a working spouse, for instance, that individual could find they have a later date, or they could get caught. The accompanying partner could get caught by 7 if they're coming later. So this 7 links with 6. I'm getting into technical now, but ceasing work, full-time work abroad. No, hang on, 5. Sorry, 5. See, I don't even know what I'm talking about. 5, starting work in the UK. 7 links with 5. The accompanying partner could get dragged into being taxable earlier because of 5. And if they're working in Canada, for instance, and coming, they could actually have some of their income pulled in as well, because they're resident earlier.
So you're looking at one date then?
Yeah.
What I'm hearing. So
Yeah.
in the UK,
Yeah.
you'll use one date.
Yeah, yeah.
So it
yeah.
could be a worst case
Yeah.
scenario.
For the
working
spouse, can be.
Okay.
But this is the split years are the part that gives us the most headache.
Sure.
And particularly with the spouses as well. A lot of the time expat programs don't cover the spouse, but that can actually bring a lot of stress for the actual individual that's moving, because the spouse doesn't know what's happening with their own tax affairs. Yeah. So, as I said, split years are hard, can increase costs. There's payroll implications for it as well. I'm going to touch on domicile. You may hear various different concepts of domicile in different countries. Domicile in the UK dictates how we tax things that are outside of employment income, but it does impact upon the overseas workday relief claim. I'll touch on it quickly. General law concept, it's dictated by where your father was domiciled at the date of your birth, not your mother. Which gives you an origin of a domicile of origin. You can then take an origin of dependency if your father's domicile changes during your infancy, which is until 18, and then after 18 you can make a domicile of choice. Deemed domicile is where I talked about the 17 years for inheritance tax. If you live in the UK for 17 years, you could still have a non-UK domicile for inheritance for income tax, but a deemed domicile for inheritance tax. As I say, domicile impacts how we tax investment income. When individuals, you may have seen stuff in the paper on why everyone's leaving the UK, particularly rich foreigners, Americans and things, are leaving the UK because after 7 years of being in the UK, to keep your non-domicile not being taxed on investment income that you have that's outside of the UK, you have to pay a £30,000 charge. And once you've done 12 years, you have to pay a £50,000 charge to keep that status. And often people think, well, that's too much, because the stuff I have outside of the UK is just not, if I paid tax on it, it wouldn't be £30,000. So the tax return then becomes more complicated because you're having to put all your investment income upon it. Be like the US then, you're putting everything in the return. Right, how am I doing for time, Brandy? I've got 5 minutes. Have I? Okay. Because I haven't even got going yet. Right, RTI. So that was a statutory residence test, okay? So this is dictates whether somebody's resident or not. That then leads into, well, how do I payroll a resident or non-resident? So RTI is real-time information. Let's not worry about that side, it's quite wordy. I did give this deck of slides to my branding team and they just left this one as it was. So from 6th of April, we now have to do monthly returns in the UK for payroll. Previously, you did an annual return where you would put all your employees down, what social security they paid, what tax they paid. You'd give them their year-end certificate, T4 equivalent, and that was that. And you could do in year. You could have people on the month end in March and true it all up and make it good and make it look pretty for the revenue, so they were happy. For anyone you'd missed off. Now it's monthly. You have to monthly report who's on your payroll in that month. If you've missed anybody, you can go back and amend. If you start going back and amending, then the revenue are going to start flagging you up for an audit, which means then you haven't got them on payroll for a particular month. And it's difficult with expats because you send them over, you may have missed payroll cut-off. You may not even realise they're there for payroll purposes. So you can get into a bit of bother with it, if you like. Revenue have moved down this route. This monthly reporting around one is benefits. UK benefits are dictated by your income and things like that, so it helps the revenue dictate what benefits people can get, child benefit and things like that. It's also, they're linking in with immigration. So if you've got somebody on your payroll that hasn't got the proper payroll immigration clearances, they are going out to employers and saying, you haven't got right immigration clearance for that individual because they've got a link in now with the immigration, and we're seeing that. There is relaxation around RTI for expats, and this is what I'm talking about at the bottom here. For locals that you send, locally employed people, there is no relaxation. You have to do RTI for them. There has to be a monthly return. For modified local, people are paying their own taxes, but are still linked back to their home employer, Canada. Again, RTI has to be done on a monthly basis. But for those that are seconded to the UK and tax equaliser, balance sheet approach, hypothetical taxes deducted, you're running a shadow payroll in the UK to account for the tax. You can run what's called a modified payroll, this is the Appendix 6 here, which gives you relaxation around the RTI requirements. You only need to do estimated tax payments. You can base it upon static pay, and then you can true up in April at the end of the tax year to account for any one-off payments, bonuses, restricted stock units and things like that, and you can true that up at the end rather than having to worry about it every month. And anything that they're getting in their home country in Canada that was paid locally here, if you were doing that. So just give some relaxation to employers around this. 7A and 7B are for Social Security. It also allows you the ability to put through the overseas workday relief up front, and also detached duty through the payroll. So you can get some sort of immediate tax savings on your tax equalised individuals, if they're entitled to it, of course. That was RTI. That was very quick on RTI. I could probably do a day on RTI, but I'd probably fall asleep myself. Right, NT codes, again I mentioned, if you get NT codes are for those that are non-resident of the UK, you're still payrolling them from a shadow perspective because of Social Security. Typically, that's what we see. Employers used to self-assess a no tax code and stick it on the payroll and pay no tax. Revenue don't like that. If you do that under RTI, you'll get a penalty, unless you've got formal approval from the revenue to do so. You can do group applications now for groups of people. The revenue didn't see a problem with this, but it takes them 8 weeks to read their post. By that time you've sent the person and should be on an NT code. They didn't see a problem with this, but we're working with them around a sort of workaround. But at the moment you need to apply for it, get it in place, and then apply it. But up to that point it's received, you should be applying PAYE. This is for your outbounds. They may not have become and they may be non-resident earlier. I think I've covered most of that. It's around, people can easily switch residency status is the key one here. You might think somebody's non-resident, but because their days back, 30 work days, 90 President's days, etc., they may actually have not broken residence. Still a payroll obligation. You've got to just be a bit careful. That's the data piece, making sure you know what your employees are doing. Right, this is an exciting one. I think everybody was waiting for this. Short-term business visitors. So this is hard stuff. People visiting the UK who are not officially on secondment. So they're coming in, they're doing a couple of weeks here and there, and then they're leaving and things like that. Baseline is anybody that works in the UK for 1 day has a tax liability. There should be a payroll operated for them. Now that's just unworkable. And that's always been the case. RTI is even more strict on that now. But where you have a treaty, Canada and the UK have a treaty, and provided you meet the conditions of the treaty, you haven't done more than 183 days in the UK, you haven't recharged your costs to the UK, and they're not working for their employer in the UK, so a sub isn't their employer, a branch isn't their employer, well it is, but it isn't for this purpose. Then, provided you meet those conditions, then the treaty applies, but that doesn't immediately give you relaxation on the payroll obligations. So what the revenue are starting to say now is we want employers to have what's called a short-term business visitor agreement, Appendix 4. You sign up to that. It's for the payroll. It's for the company. It's not an individual application. And that's to say that, look, we have people coming in from treaty countries. We meet the conditions of the treaty for those people. We hence have not put them on the payroll, but we do track them and we know who they are. So at the end of the year, we will tell you who those people were. And in this agreement, there are certain criteria. Typically 0 to 30 days, you don't have to tell the revenue anything. Gives you some protection on up to 30 days. 0 to 60, the same, unless they've got a contract for this sort of formal posting. But typically we don't see that. So you've generally got up to 60 days of not having to worry about people in the UK. After that, 60 to 90, 90 to 150 days, 150 to 183, there's different levels of information you have to give to the revenue by the end of the tax year, which is all lovely, but the problem we obviously employers have is knowing who's coming to the UK, who has travelled from Canada to the UK. How do we know who's there? Who's the stealth commuter? You know, PwC don't know I'm here probably. So if you had the equivalent here, I don't know. But it's that sort of thing. It's just keeping a track of those regular visitors into the UK. And making sure you can report upon it. Prior to 6th of April, employers said, yeah, treaty applies, we've got a process, fine. There were 700 applications only in the UK. We have more than 700 employers in the UK. We're going to see more applications being made now and people doing the correct tracking. We have solutions to do tracking of people, from taking data downloads from travel agencies and monitoring timesheets if people do timesheets to see where people are. But the tracking piece is the difficult piece.
Is 30 days the limit for the year-end reporting, or is 30 days, like if you have people going under 30 days, you don't even have to do an Appendix 4?
You need to do the Appendix 4 to give you that protection, the 30 days. Yeah, it gives you that protection. So, and up to 60 as well, actually.
So that appendix would have to highlight who the individuals were that were exempt. I'm just wondering if someone came in to have a look or asked you, how you arrive at the fact that you don't have any travelers that
well, that's the thing.
are taxable. How would you support that?
You'd need to show, look, well, I do for one of my clients, so they send me all their travel data, which is lovely, a big thick report, and we go through it, and we highlight the people that have travelled to the UK. A lot of them were under 30, but we know who they are. But a lot of them, I think 2 of the 50 people on this report, I think 2 had done more than 60, and you just write in saying Joe Bloggs did more than 60, and some of the data you need to give, and that's it. But we know who did less than 30. But it gives you that protection as well.
That you're reasonably making that
Yeah,
judgment.
yeah.
You'd have to have something to support.
You've got to have something to support it, absolutely. And if you still have people that are less than 30, less than 60, you do a nil return because you've signed up for the agreement that you'll tell the revenue who came to the UK. If nobody came above the limits, you still need to tell them that you didn't have anybody. But you need to do the tracking and the audit to make sure. All right, I'm going to shut up soon. Tax risk assurance, I've only got one slide on this, I think. Basically, this comes back to real-time information. So if you start payrolling and you start doing amended returns every month because you've forgotten some employees, the revenue aren't going to like that. They are going to start restricting how many amendments you can do to a prior month's payroll. But the more you do, the more you're raising the flag to the revenue. In addition, revenue in the UK have not done PAYE audits, payroll audits on many employers for more than 6 years. They used to do them every 3 to 5 years, but they just haven't had the manpower. So they're now going to start focusing on certain audits. Short-term business visitors and expats are an easy win to go into an employer and try and pick off and try and get some tax. And that's what we're going to start seeing some more of. There's a concerted effort by the revenue now to do this. This is another slide that didn't get branded because it had too much words on it. Some of the companies in the UK that meet the criteria here, having a turnover of more than 200 million or a gross balance sheet of more than 2 billion in assets, will have to have a senior accounting officer, and that's an individual that sits in the UK and signs off that all the compliance, payroll, and all these taxes here are being done correctly. The headache for most senior accounting officers within companies is the payroll. They just don't have line of sight on it. They don't know if it's right or not. In most cases it's wrong because it's hard to get right. We're doing a lot of work around this, and you can see the penalties here. If you get it wrong, there's a £5,000 penalty for the actual individual themselves. And I'll come back to the immigration point. If your RTI, you've got people on the payroll that haven't got immigration clearance, and you've got somebody in the firm that sponsors the visas, which some companies do, they can go to prison. It's fairly self-explanatory. It's just what the revenue expect of the SAO around expats and payroll. And now I'll be quiet. So any questions? I must have done well. Well, I'm hanging around afterwards, so if anyone's got any questions they want to ask me directly, then please do. I think you're next, Brandy. Oh, that's me. Look, there you go.
Well, thanks. You certainly walked us through a number of the changes in the UK, and I can't stress how much we appreciate that. Obviously, the changes are very complicated, but I think the biggest takeaway that I'm going to take away from it is that with the proper planning and obviously the reporting and the tracking, we can mitigate most of the impact that that's going to have on our UK businesses. But I think another important takeaway is, you know, what's going on in the UK is no different than what's going on in other jurisdictions around the world. As Justin mentioned, you know, the rules have been there for a while, especially as it relates to foreign short-term business travelers. But various jurisdictions haven't always enforced them. But now we're seeing more and more as these jurisdictions are looking for other revenue sources, they're starting to look specifically at this area and putting more supportive legislation and rules in place to ensure that individuals are being compliant. So it really is about getting the proper tracking and reporting at the employer level so that you know where your travelers are traveling to, how frequently, and how long they're staying. And the onus is really coming down to the employer to keep track of that and to report on it. So thank you again, because I think it highlights a bigger issue that we're just going to have to face as we continue to send people abroad. Obviously, great presentations such as this one do not go off without a strong supportive team. And I'd like to thank Fiona Lai and Alison Cumming, who have worked tirelessly to ensure that we were able to pull this off today. Also, our hosts of St. Andrew's Club. Justin, as he mentioned, and Mike and Dave are going to be staying behind, so if you have any more questions or concerns, please do take the opportunity to speak to them. And finally, we do have a list of brochures and some sign-up sheets, distribution lists, which have more information on some of the upcoming breakfast seminars we'll be hosting, plus a series of podcasts. Also included in your sheets is this link, which also links you back to some more recent webcasts that we did and podcasts. So do take advantage of that. And lastly, have a great day. Thank you again.